Hi, I'm Brennan Decima, owner of Decima Wealth Consulting. Today I'm going to share a client story that we had this week that I think is really impactful on the importance of minimizing and reducing taxes in retirement. So I had a client couple come to me this week that they've done everything right. They decided that they wanted to step away from the workaholic culture. Both of them had been running at full speed on the treadmill. They wanted to get off the treadmill. And they really wanted more time for leisure, more time with activities that bring them joy. They want to travel the world. They want to spend time with their kids. So I'm really happy for them, really excited. And unfortunately, there was a catalyst moment for the clients that made the light bulb go off. The husband's dad had passed away years ago, and recently his mom was checked into memory care. She's in her 70s. So for him, it was just this mortality type realization of, while we're still young, healthy, and able, let's use that to our advantage. We've done a great job saving. And the reason they came to me is they already had a financial advisor, but their biggest concern in retirement was not, do they have enough money to retire? They knew that with the $5 million. What they were looking for was a plan of how to generate income to support their peace of mind. But their biggest concern was, how do we lower our tax bill in retirement? And their advisor ran a Monte Carlo simulation. He didn't review the tax forms. He wouldn't review the tax forms. So they said, hey, let's go get a second opinion. And that's where I come in. Now, before we go into the client situation, I want to make a point here, and I want to emphasize this. We don't want the tax tail to wag the retirement dog. And what do I mean by that? Taxes are not necessarily a bad thing. I'm not saying, hey, I don't want new clients because my income might go up and I don't want to pay more taxes, right? That's foolish. I want more income. I want more revenue. And for these clients, I don't want them to restrict themselves where they're not doing anything. They're not spending on joy, travel, fulfillment solely to avoid taxes. The exercise is really determining, what do we want to do in this next chapter that's going to bring us fulfillment, joy, and purpose, and what does it cost? And once we know what it costs, what I am doing is determining, how do we pay the lowest possible taxes over your retirement to live the retirement lifestyle of your dreams? So I'm going to share the exact steps we took with this couple to put them in a path to clarity and confidence and really lower the tax bill on retirement. So let's get started. This client, they had $5 million in savings. So $3 million was in their 401k. So qualified money. Now, qualified money, what is that? They got a deduction when the money went into the 401k. Now, they were both high earners, collectively making over $500,000. Really good decision because they avoided taxes at that 37% federal rate, and they're going to be able to take it out down the road at a rate much lower than 37%. So really good decision to put it into their 401k. And they did that. They maxed it out for years. They saved. They didn't panic when the market dropped. And now they have $3 million in their 401k here at retirement. So early retirement achieved. They also have $2 million in non-retirement accounts. So some of that is cash and checking and savings, and some of that is stocks in a brokerage account, right? So $2 million in non-retirement, $3 million in retirement, $5 million saved. Now, the advice that they were given and the magazines that they read said that there is a hierarchy of withdrawal. And the advice that they were given says, leave your 401k alone as long as you possibly can. You have money in checking account. You can take money out and pay no taxes if you just use your cash. And on the surface, that sounds great, right? Who doesn't want to pay no taxes? But the risk of that is twofold. So if $3 million stays in the 401k until they have to touch it, well, that's 17 years from now. So they will be required to take distributions at age 75, the mandatory required distribution. At 75, that's 17 years of growth. So let's say that 3 million very conservatively grows by 7%. And they've been growing by a lot more than 7%, but let's say they get 7%. Well, at age 75, they're looking at $9.5 million in their 401k. Good problem to have. Not too many people are complaining about that. But when the mandatory distribution starts, they're going to be looking at income of $400,000 to $500,000 per year. So they're back in the 32% bracket, right? So that's a pain point. Now, if one of them passes, that required distribution is still there for the surviving spouse. And now the surviving spouse has a much more compressed tax bracket. So if that $500,000 in income needs to come out, it's now at the 37% bracket. So that's a huge ticking tax time bomb. So with these clients, what we said was, hey, let's look at this a little bit differently. Let's fill up the 24% tax bracket. So the 24% tax bracket in 2025 is about $390,000. And with the standard deduction, it's about $420,000. So what they're doing is they need $150,000 in income per year. So what we're doing is we're taking $150,000 from the 401k, and they can do this, rule of 55, so no penalty. And then we're taking the remainder and doing a partial Roth conversion. So we're taking $420,000 out of the retirement account. The marginal rate is 24%, much higher than paying zero. But if they grow by 7%, their $3 million will be completely out of qualified accounts by 75. And all of that growth that they would have had is now tax-free. It's in a Roth account, and Roth accounts do not have a mandatory distribution. So a couple things to be aware of with Roth conversions. There is no income limit on Roth conversions. Anything you convert is added to your ordinary income. So if you do $1 million, you'd be taxed at 37%. So this is where partial Roth conversions come in. And if we do them before Medicare starts, we don't have to worry about IRMAA. If we do them before required distributions, we can get it out of the required distribution calculation. So really, really powerful tool to do Roth conversions. It gets all of that growth growing tax-free instead of tax-deferred, and it really, really protects the surviving spouse. So the math that we did is if we can get $307,000 per year out of their retirement account, they're going to stay in an effective tax rate of 18% overall. And then from 73 on, they have no required distributions, and they've preserved their brokerage account. So what that does is it gives them a huge bucket for later in life medical. It gives them a bucket if they want to do home renovations or relocate without having to take from the retirement account. So preserving that gives much more flexibility later in life. The other thing it does is there is a tax break for the surviving spouse on the gains. So by investing that and leaving it alone, when the first spouse passes, that brokerage account is going to get a step up in cost basis. And you can see my other videos that explain that. But there's a huge tax benefit when you leave behind a brokerage account. There's not a huge tax benefit when you leave behind a traditional IRA or 401k. So in this client situation, we dramatically reduce their overall tax burden. We dramatically reduce the required distribution, and we dramatically improve the tax-free growth of their overall nest egg. So the surviving spouse has significantly more dollars to access at their fingertips. The family, they have 2 kids. The kids have significantly more money tax-free if something happens to both of them. So again, really, really powerful story. But I think what's really, really key here is everyone's tax situation is different. So creating a retirement income plan, it's not always who has the biggest balance. It's who has a coordinated plan where, first and foremost, your tax situation is understood. So we did a detailed review of their tax return. We did a detailed tax modeling analysis going forward. We then looked at their retirement income needs and determined what is going to be their tax cost if they take from particular buckets, and we played with those scenarios to show the lowest total tax cost over the length of their retirement. We then built an investment strategy that coordinated the taxes and the income needs. So everyone is different when it comes to taxes. Everyone is different with income needs. Making sure you don't just run a Monte Carlo and say, hey, let's take 4%. You could be paying significantly more taxes on your income than you need to. So again, we don't want to avoid taxes for the sake of restricting, but we don't need to tip the IRS either. We want to make sure we understand how to use the tax code to our advantage so we're not paying anything unnecessary for either us or our family. So hopefully this is helpful. If you want to read the article, visit our website, www.decimawealth.com. And if this is helpful, please subscribe.